Last Monday, Apple held what Tim Cook called the most important software announcement in the company's history. A completely rebuilt Siri, a billion-dollar AI partnership with Google. It even featured cinematic moments like Tim Cook wiping away tears on stage before handing over the keys to Apple's next leader. So how did this all affect the stock? That's where things get a little interesting. The stock was actually up that morning, but as Apple was unveiling its biggest AI announcement ever, live on stage, the selling started. Investors weren't waiting to the end to react. They were selling during the keynote. And as I'm recording, the stock is still at depressed levels. Now, that's been a few days. The reaction deserves a hard look because the business didn't change, the product roadmap didn't collapse. So when a $4 trillion company puts on the show of the decade and the market starts walking away, you have to ask, is this a warning sign or one of the better buy the dip opportunities for Apple we've seen in quite some time? Now, I've had a few days to review all this and I've been running the numbers and the data is quite clear. So stick with me for that answer. By the way, I'm Steve Reitmeister. I've been investing for over 40 years and I'm currently a partner at WallStreetZen.com where I help develop a quant rating system to help investors quickly find the best stocks. And today we're going to put Apple through the system to see what it has to say. If that sounds good to you, then please hit that like button. It tells the algorithm that you want to see more deep dive videos like this one. And no doubt you already know this, but while I'm sharing data with you today, any investment decisions are yours and yours alone. Always do your own due diligence before investing. Okay, let's dig in. First, we need to talk about the buy the rumor, sell the news problem that may have happened here because Apple appears to be living in that reality right now. For months, Wall Street had been building up towards this moment. Apple's Worldwide Developers Conference, also known as WWDC, this is their famed annual event where Apple previews its biggest product launches and initiatives for the year ahead. Before the keynote, the stock had already run up more than 50% over the past year. Every analyst note, every leak report about a rebuilt Siri was adding fuel to the fire. By June 8th, the big AI win was already baked into the cake. And then Apple delivered what everyone expected. Well, almost. Okay. Yes, they introduced real features. There were impressive demos. There were even tears from Tim Cook. But there was nothing that investors could really sink their teeth into. Siri AI is launching in beta sometime this fall. But after that, there is no firm launch date for widespread release. Gene Munster is a managing partner at Deepwater Asset Management and one of Wall Street's most well-known Apple analysts. He put it plainly, the stock is falling because Apple gave no timeline. And that stings because this is year 2 of the Siri AI story. Investors have been patient, but that patience may be running out. Add to that, Siri AI won't be available in China or EU at the time of launch. Now, that's not a footnote. That's 2 of Apple's biggest markets sitting on the sidelines. So yes, you could say this is a textbook sell the news event, but really it's amplified by 2 years of unmet expectations. Now I want to look at the story from all angles, both the bull case and the bear case. And I just want to drop in that if you like this kind of approach, then we can get even more insight from my weekly live training sessions. It's totally free and includes some of my top stock recommendations. Please join the next one this coming Monday at 7 p.m. Eastern Time. Just scan the QR code on your screen to register for free. Let's start with the bull case for Apple. First, consider the most recent quarter. Revenue was up 17% year over year. That's very impressive for a company of this size. The main driver was strong demand for the iPhone 17. And their services business, which includes the App Store, Apple TV Plus, iCloud, and Apple Pay, hit a record $31 billion in revenue with juicy 75% gross margins. That service business is the key. It's high margin, recurring, and it grows as Apple's installed base grows as well. Right now, Apple has more than 2.2 billion active devices in the world. That is an unmatched distribution network for any AI product they roll out in the future. And yes, Wall Street analysts are largely still bullish. Right now, 16 analysts tracked by WallStreetZen are issuing recommendations on Apple. The coverage is mostly bullish with 11 buy or strong buy recommendations in total. The most bullish price target suggests this stock could see over 35% upside in the coming year. What's driving that optimism? Analysts see Apple's AI push unlocking a major new revenue stream. For instance, Bank of America is projecting between $15 to $30 billion in AI-related revenue by 2030. And here's one last thing that the market may be missing. Apple revealed that the most advanced Siri AI features required 12 gigabits of memory. which is more than the standard iPhone 17. That means a vast army of users will need to upgrade to get the full AI experience. And yes, that will be around the time the iPhone 18 launches this September. Now, when you appreciate the strong recent results, coupled with the AI growth potential, then you fully embrace the bull case. Okay, now it's time to shift into Debbie Downer mode and talk about what concerns me about Apple. Now, there are real risks here. For one, valuation is getting a bit stretched. Apple's forward PE is sitting around 33 times expected earnings. That is well above their long-term average of 27 and even further removed from the large cap average of 20 times earnings. That extra premium is built on the assumption that Apple's AI story actually delivers. Now, if Siri AI keeps getting delayed, if the upgrade cycle disappoints, or if competitors eat into Apple's ecosystem, well, that premium gets hard to justify for these shares. There's also a margin headwind. Tim Cook warned that memory costs are rising sharply, and gross margin guidance for the next quarter came in lower than what they just reported. This is not catastrophic, but something worth watching. And then there's the CEO transition. John Ternus is well regarded inside Apple, but handing over the keys of a $4.5 trillion empire over to a new driver always carries some risk. Okay, so the bear case has some merits too. So now let's take a look what our Quant ratings model has to say about Apple shares as the deciding factor. And by the way, if you're liking this approach, then please do your future self a solid and hit that notification bell and subscribe to the channel. That's because I release videos like this several times per week, and it's the best way to ensure that you don't miss the next one. Now, for the metric that I find more telling than analyzing the single news catalyst, I'm talking about the Zen rating. The goal of the Quant rating system is pretty straightforward. Analyze 115 unique factors for every stock to identify those with the highest likelihood of outperformance. Then we distill it down into an intuitive letter grade of A through F. Just like school, you want more A's on your report card. Now, keep in mind, the ratings are updated every day, so what I'm showing you reflects the data as of the time of recording. Always check the quote pages on WallStreetZen.com for the latest Zen ratings. Right now, Apple has a Zen rating of C, which is a middle-of-the-road hold grade. The main ray of sunshine here is that it's actually in the top 33% of all stocks analyzed by the model, but only the top 20% are rated buy or strong buy. Helping create that overall rating, there are actually 7 component grades. Think of them as the 360-degree breakdown of a stock across dimensions like value, growth, momentum, safety, and so on. These 7 additional ratings help us appreciate the unique strengths and weaknesses of any stock. I'll start with the good news. Apple scores an elite A rating for financials. That is because their balance sheet and cash generation are truly legendary. Then it scores a B for both momentum and AI factors. These are 2 different measures that often point to the most timely shares. But for value, growth, sentiment, and safety all grade out at C. Not bad, but not really great either. As we discussed earlier, there are concerns about value of these shares. So that C grade makes sense as it scores in the bottom 40% of all stocks. The growth grade is even worse, in the bottom 33% of all stocks. That is because they have not grown as consistently as other stocks, which does call into question the likelihood of future earnings beats. Let's put it all together. Apple is still a great company. No one's questioning that, but it may not be a great investment at the current price. So if Apple is a hold and unlikely to outperform the market, then what do you actually do with that information? Well, if you already own Apple as a long-term investment, then there's no harm in keeping your shares. If you're not in the shares, then there's no rush to take action. Just put in your free watch list on WallStreetZen.com to see any changes in the Zen ratings or analyst recommendations that would make it more appealing. One of 2 things needs to happen to make Apple a more attractive investment. First is to drop in price to make the valuation more reasonable. Second is an acceleration of growth expectations, and perhaps that comes with the iPhone 18 launch and AI initiatives. Preferably both happen to increase the odds of future outperformance. Now, if you're looking to put your money to work right now, don't let a hold on Apple keep you on the sidelines. There are plenty of stocks out there today with top-notch A and B Zen ratings. Stocks the system is flagging as having genuine upside potential right now. If you want a fast forward button to locating some of those high potential picks right now that I invite you to attend my next Wall Street Zen live training session on Monday at 7 p.m. Eastern Time. In addition to looking at the market at large, I also unveil my trade of the week, combining the best of the Zen ratings with my greater than 40 years of investing experience. If that sounds of interest to you, then go ahead and register for free at wallstreetzen.com/live, or you'll find the link in the description below, or scan the QR code on your screen. But whatever it takes, I look forward to seeing you on Monday. The bottom line on Apple is that it sports a Zen rating of hold for good reason. The stock isn't cheap, the AI timeline is uncertain, and a CEO transition adds a layer of near-term unpredictability that's hard to ignore. Now, what do you think? Did you identify more with the bull or bear case for Apple, and why? Please share your thoughts with our community in the comments section below. And if you like this video, be sure to check out the one I just published analyzing the highly anticipated SpaceX IPO.